78% of professional money managers fail to beat the market over a 10-year period, yet a simple investment strategy has consistently outperformed these experts, and it's available to everyone. In this video, I'll reveal this strategy and show you how it can potentially turn your modest savings into $1 million portfolio. It's the same method used by some of the world's smartest investors, and today you'll learn how to use it too. Imagine you're setting out on a quest to find buried treasure, but instead of a map, you have a stock market chart. Confused? You're not alone. Many people feel lost when trying to navigate the stock market. It's like being handed a complex puzzle without any instructions. You know there's potential for great rewards, but the path to get there seems obscure and filled with risks. Here's something that might surprise you. Even the professionals struggle with this puzzle. In fact, 78% of professional money managers fail to beat the market over a 10-year period. That's right, the experts who dedicate their entire careers to understanding the stock market can't consistently outperform it. So how can the average person hope to succeed? This is where index funds come into play. Think of an index fund as a treasure map that leads you to multiple smaller treasures instead of one big one. Instead of trying to pick individual winning stocks, which is what those professional money managers are attempting, an index fund allows you to own a piece of hundreds or even thousands of companies at once. Let me break it down for you. An index fund is a type of investment that tracks a particular market index, like the S&P 500. The S&P 500 includes 500 of the largest companies in the US. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all these companies. It's like owning a slice of the entire American economy in one simple package. The beauty of this approach is its simplicity and effectiveness. You're not trying to outsmart the market or predict which companies will perform best. Instead, you're riding the overall growth of the economy. And historically, the overall market has trended upwards over a long period, despite short-term ups and downs. Now, you might be wondering, everyone, how this can turn your modest savings into millions. Well, it's all about the power of compound growth over time. When you consistently invest in index funds and reinvest your earnings, your money has the potential to grow exponentially. It's like a snowball rolling down a hill, getting bigger and bigger as it goes. So why do 78% of professional investors fail to beat index funds? It's because trying to consistently pick winning stocks and time the market is incredibly difficult, if not impossible. Even with all their resources and expertise, these professionals can't reliably outperform the simple strategy of investing in the market as a whole through index funds. Now that we understand the map to potential millions, let's look at our first checkpoint in this quest for wealth. We're going to explore a powerful strategy that can help you build your fortune consistently, even if you're not a financial genius. Are you ready to take the next step on your journey to financial freedom? Let's go. Forget about timing the market or making complex financial decisions. What if I told you that the path to becoming a millionaire is more about consistency rather than cleverness? Let's explore how a simple, steady approach can outperform even the most sophisticated investment strategies. Enter the world of dollar cost averaging, a powerful yet straightforward investing technique that's perfect for our index fund strategy. Here's how it works, everyone. You invest a fixed amount of money at regular intervals, regardless of what the market is doing. It's like setting up an automatic transfer from your paycheck to your investment account every month. Now, you might be wondering, why not just invest a lump sum when the market is low? Well, here's the catch. Even the pros can't reliably predict market highs and lows. With dollar cost averaging, you're not trying to time the market. Instead, you're spreading your investments out over time, which can help reduce the impact of market volatility on your portfolio. But let's be real, staying consistent when markets are volatile isn't always easy. When you see the value of investments drop, it's natural to want to pull back or stop investing altogether. This is where the real challenge lies. It takes discipline to keep investing when the market's down, but that's often when the best opportunities arise. Think of dollar cost averaging like training for a marathon. You don't prepare by sprinting as fast as you can for short bursts. Instead, you build up your endurance with consistent, regular runs. In the same way, consistent investing helps build your overall financial endurance over the long term. There's another benefit to this approach that often gets overlooked: the psychological aspect. By automating your investments, you're removing a lot of the emotional stress that comes with trying to time the market. You're not constantly worrying about whether now is the right time to invest, and this can lead to better financial outcomes in the long run. In fact, research backs this up. A study by Charles Schwab found that in 74% of cases, investors who invested immediately and held for 20 years outperformed those who tried to time the market. That's a pretty compelling argument for consistency over trying to be clever with market timing. So what exactly is dollar cost averaging and how can it make you rich? It's a method of investing a fixed amount regularly over time, regardless of market conditions. By doing this, you're buying more shares when prices are low and fewer when prices are high. Over time, this can potentially lower your average cost per share and increase your returns. With our first checkpoint cleared, we've learned the power of consistency in our wealth building journey, but there's more to explore. Next, we'll look at how to choose the right vehicle for your investment journey. Are you ready to take the next step towards your $1 million portfolio? Let's get into it. Think all index funds are created equal? Think again, my friends. As we dive into the world of wealth vehicles, you'll discover how a seemingly tiny number could cost you hundreds of thousands of dollars over your investing lifetime. Let's talk about expense ratios. These are the fees that you pay to the company managing your index fund. Now, you might be thinking, fees? I thought index funds were supposed to be cheap. Well, they are, but some are cheaper than others. And when it comes to building long-term wealth, even small differences in fees can have a huge impact. Imagine that you have two treasure chests. One has a tiny hole in the bottom, while the other is completely sealed. Over time, that small hole in the first chest will let coins slip out, slowly but surely reducing your wealth. That's what high fees do to your investments. Now, that might seem insignificant at first, but over decades, they can seriously eat into your returns. This is where Vanguard comes in. They're often called the gold standard of index funds, and for good reason too. Vanguard's fees are incredibly low. Take their total stock market index fund, for example. It charges a mere 0.03% in fees. That's just 30 cents for every $1,000 you invest. But Vanguard isn't just about lower fees. They have a whole philosophy built around helping average investors succeed. The company was founded by John Bogle, who many consider the father of index investing. His vision was to create a way for regular people to invest in the market without getting ripped off by high fees or complicated strategies. What makes Vanguard stand out is their commitment to keeping costs low. They've actually been lowering their fees over time, which is pretty rare in the financial world. This means more of your money stays invested and has the chance to grow over time. Another great thing about Vanguard index funds is how easy they are to manage. You don't need to constantly buy and sell or worry about beating the market. The funds are designed to track specific market indices, so you can just set it and forget it. It's a much less stressful way to invest. Now, think about the impact of choosing the right fund over decades. Let's say you invest $10,000 and add $500 every month for 30 years. Now, with a fund charging 1% in fees, you might end up around $900,000. But with a Vanguard fund just charging 0.03%, you could have over $1 million. That's a difference of $100,000 just from fees alone. So why is Vanguard considered the gold standard for index funds? It's their combination of rock bottom fees, investor-friendly philosophy, and a long track record of helping average people build wealth. They've shown that you don't need to be a Wall Street genius to invest successfully, which is great. Now that we've chosen our vehicle for this wealth building journey, it's time to look at the different paths that we can take. Are you ready to map out your own route to potential millionaire status? Let's dive in. You've got your map and your vehicle, but which road will lead you to your $1 million destination? Let's talk about asset allocation and the free fund portfolio strategy. This is where your journey gets really interesting, guys. Asset allocation is all about how you divide your money between different types of investments. It's like choosing between taking the scenic route or the highway on a road trip. Each path has its own risks and rewards. The challenge is finding the right balance that suits your goals and comfort level. Now imagine you're planning a trip, but you might take the highway for speed, but you'd miss out on the beautiful views. On the other hand, the scenic route might be the one to take, more enjoyable, but it can take longer. Investing is very similar. Stocks are like the scenic route, potentially more rewarding, but with more ups and downs. Bonds are like the highway or motorway for your UK viewers, generally smoother, but with potentially lower returns. This is where the free fund portfolio comes in. It's a simple yet powerful strategy that uses just free funds to give you a well-balanced investment mix. Here's how it typically works. First, you've got a total US stock market fund like Vanguard's VTI. This gives you exposure to the entire US economy. Second, there's an international stock fund like VXUS, which helps you tap into global growth. And finally, there's a bond fund like BND, which adds stability to your portfolio. The beauty of this strategy is that it's simple to set up and easy to maintain. You're not trying to pick individual stocks or time the market. Instead, you're capturing the performance of entire markets. And the best part, guys, you can adjust this mix as your life changes. For example, when you're young and have time on your side, you might have more in stocks to maximize growth potential. As you get older and closer to retirement, you might shift more into bonds for stability. It's like adjusting your route as you go along your journey. Now, you might be wondering about the difference between ETFs and index funds. Both can be great options for your free fund portfolio, but they work a little bit differently. ETFs can be traded throughout the day like stocks, while traditional index funds are bought and sold at the end of each trading day. ETFs often have lower minimum investments, which can be great if you're just starting out, but traditional index funds might offer features like automatic investment options that some investors find very helpful. As we near the end of our quest, it's important to remember that becoming a millionaire through index funds isn't about finding a shortcut. It's about choosing the right path, staying consistent and adjusting your course as needed. Now, we've covered a lot of ground on our quest to millionaire status through index fund investing. Let's recap the key checkpoints that we've passed. We started by understanding what index funds are and why they're such a powerful tool for building wealth. Then we explored the importance of consistency through dollar cost averaging. We also learned how to choose the right fund, focus on low cost options like Vanguard. And then finally, we mapped out our route using the free fund portfolio strategy. Remember, becoming a millionaire through index fund investing isn't about getting rich quick. It's more like a marathon than a sprint. You need patience and discipline to stay the course, especially when markets get rocky. But here's the thing, you don't need to be a financial genius to succeed. You just need to start and stay consistent. So here's my challenge to you, my friends. Start your own wealth building quest today. Even if you can only invest a small amount right now, that's okay. What matters is you begin. As Warren Buffett said, the stock market is designed to transfer money from active to the patient. Are you ready to be one of the patient ones? Your future millionaire will thank yourself today by starting now. Like, subscribe, and let me know in the comments below what index funds you're invested in and how long it will take you to become an index fund millionaire.